Hi, my name is Alex Carlich with Gustan Associates. I'm going to talk to you about the steps of us pre-approving you and what we are thinking in our minds when we're asking all these questions. So the first thing we're going to want to know is how's your credit. We're going to ask you how your credit is. You're going to say it's okay, I got a 600 credit score, I have some collections, maybe some late payments, and I'm going to ask you to run your, I got to run your credit that I'm not sure. So we run your credit, we're looking for your monthly debts, we're looking for a good score. We're looking to see if you have collections. If you have collections, it's okay. We can hit you for 5% if it's greater than $2,000 in total collections. If it's less than $2,000, we don't hit you for that. And we see charge-offs. We don't hit you for charge-offs here. So we're looking for all your monthly debt. If they hit you for 5% of your collections, we add that to your debt side of your thing. We also want to make sure you have enough trade lines open. We may determine that you may not qualify due to a bankruptcy, the Chapter 13 that you're in. So we'll have to downgrade you to a manual underwrite. We'll determine all these things by looking at your credit. If you have a Chapter 7 and you're 2 years discharged, we're happy because we can do it because that's the rule. You need 2 years discharge from a Chapter 7. So your credit report really tells us if we can even possibly start. That's the first hurdle that we have to leap over when doing your loan pre-qualification. So once we've said, okay, your credit's doable, what's your income to support your mortgage payment and all this debt you have? So if you're straight W-2, salary job, makes our life easier. If you're self-employed, we're going to be averaging your tax returns, your adjusted gross, not your gross like we'll go off your W-2s. We go off the big number, not after what you clear. We go off your gross. When it comes to self-employed, we use adjusted gross or the net, so that's after you have your deductions. So when you're self-employed, we need to know that. We need to see your tax returns to determine that. So we may ask to see your tax returns. And we'll determine a lot of other things. If you've been switching jobs and you're going from a 1099 to a W-2 job, that's okay. If you're going to a W-2 job to a 1099, that's not okay because you need 2 years of self-employment history. So a 1099 is considered self-employment history. Or let's say you've been a doctor working for a hospital for 20 years and you just open your own practice for a year. We can't use it because you are a brand new business. So we determine your job history, all that kind of stuff. We also want to see 2 years consecutive work history. If you have some job debts, that's okay if we can prove it prior. So we're looking for income, we're looking at what we can use, what your job history is like, and what type of income you're getting paid. We're also determining overtime, bonuses, average hourly work. So there's a lot of complications if you get paid anything different than a straight salary. So we need to go over that. So once we determine your income, let's say we say, okay, your income's good, and with the debts that you have, this is what you're going to qualify. So for FHA, we can go to 46.9 over 56.9 debt to income ratio. If you have good credit scores, maybe we'll go to conventional. We can go 49.9 over 49.9. So we'll determine which way we're going to go, conventional or FHA, based on your credit, based on your income, based on your debt to income ratios. Also your down payment, your job history may determine what type of program we can do because conventional has some 1-year tax return programs if you've been self-employed for 5 years. In the previous years, a bad average, we can go off the most recent year only. So we can determine things like that by going over your income and your credit. Once we determine if we're going conventional or FHA, then we have to look at how you're going to get the assets and the closing cost credits and what kind of money you have to get to the closing table and how we're going to finagle that. So if you say, okay, I have $2,000 in my bank account, I'm like, well, how are you going to buy a house? And you say, oh, I got $10,000 in my mattress, I'm going to throw it. No, you can't put the $10,000 in the mattress. So assets are very important. We need to know exactly where every penny that goes towards this transaction came from. Underwriters want to follow the money. Now, we ask for 2 months bank statements. If there's any large deposits, they have to be sourced and proven. So when I say sourced and proven, we cannot use cash deposits. You can't have 10 quick pays of $1,000 each, and that's your down payment money from your friends. It has to be gifted to you, has to be payroll. IRS refunds are okay. If you sell an asset, you have to paper trail that it's really tedious. You can paper trail it, you can prove the value of it, the bill of sale, recording of it, the title, transfer, all of it. So the assets are very crucial. That's one of the toughest things to get verified here. But let's say we verified you've enough assets to close. We've determined exactly how we're going to structure the contract. You may or may not need closing cost credits. Once we've seen your credit, we figured out your income, and we know your assets. Now we know you're ready to buy a house. And that's what we go through when we talk to you in terms of buying a house. So The other last thing we do is what type of property type you're looking for. There's different rules. So if you're buying a single family home, it's the easiest rules. Hardest rules may be a multi-unit, like a 4-unit. There's different rules for multi-units, and condos have some restrictions too, because condos have to be what's called warrantable. So if you're buying a single family home, it's easiest. Condos gets a little dicey. 4 units have a whole new set of rules. So we're going to determine what type of property you're looking for, and if the property is eligible, and if you're eligible for that type of property, because the 4-unit has mathematical calculations that it has to pass, the building has to pass. The rents have to cover the mortgage payment. Condominiums, the condominium itself has to have a strong condominium association where there's not a lot of renters, they have reserves in their account, they don't have lawsuits, there's not a lot of foreclosures in the condominium. Single family homes, when you're going FHA, just have to pass a pretty stringent appraisal. Conventional, they're in and out in 10 minutes. You can't buy a dump, but you can buy things that need a little bit of work. FHA does not let you buy things that they're falling apart. Conventional doesn't like that, but they let you buy things that are a little more dicey in terms of you could have like a gutter hanging off maybe the side of the house on a conventional, but not on FHA. So that's what we determine when we're going through the whole process with you. And I hope you like this. That's my video today, and give me a call at 630-915-7550. Go to gustanshow.com for more videos and blogs at gustancho.com. Thank you.